Hello everyone, recording a short video here on option re-ownership. We're considering what we want to do with cash grain that we had sold during fall or that we have in commercial storage. Anything for on-site storage, obviously that's an on-site storage that has the lowest cost going out to holding it to say summer or even early fall next year. So this video in option reownership pertains more again to any grain that we've already made a cash sale on or that we want an alternative to paying commercial storage. The first thing we're going to look at here is the futures market and what it has done here. We have picked up a China trade deal which has resulted in a quick round of support for the bean market while corn continues sideways. And now if we believe that this could result in an even further upside move, or perhaps the acreage report in March generates further upside, or even because we'll be using the July contract, early summer weather for 2026. So let's first dive into looking what futures have done so far. Here are those July contracts and where they have moved since fall. We see that in the case of corn, we are trading just about at the same level as where we would have made most of our cash sales. In fact, if we held on to corn and made any cash sales post-fall, still the corn price is not that far away from where we were at any point from September through current. In the beans, a little bit of a different scenario there. We see that during fall, price was about where we are now. So if we made fall cash sales and we re-own here at current levels, we are re-owning fairly close to where we made those cash sales. Since we made that China trade agreement, we did see a significant rally here in the July contract reaching up to 1180. Of course, any cash sales made there that we want to re-own, then re-owning at current levels is actually re-owning at a lower price than our cash sales. So for corn in general, we would say that we could re-own fairly close to where we made any sales, or if we plan to make any sales ahead of the January crop report. And for beans, we can re-own at the same levels as fall or possibly better if we did make any cash sales here from that China trade agreement. Let's look at our first choice here. And what we will cover first is using a call spread. Now in this example, we are using July corn, but the core ideas of how these two option strategies are going to work will be the same whether we are talking corn or beans. So again, let's first look at a call spread here. The first choice is to look at buying the 450 call and selling the 510 call. Those are the strikes we're using. When you look at this chart, you can see why we are using those strikes. We want to buy the 450 call because we want re-ownership at the fall price and very close to our current price. So that's why we are starting off with buying that 450 call. That gives us re-ownership from 450 up as high as we sell that call. So we are selling the 510 call in this scenario. So that means we get to collect from 450 up to 510. And again, why do we use 510? Looking at this chart, we see the contract highs are just under $5. So even by giving us a 510 ceiling, we can only collect 60 cents total upside. But that 60 cents to even reach that level will mean corn will have to go past contract highs on this July contract. So again, what we're trying to do is cover a scenario that basically covers 80% of the potential what we figure could happen next year. Of course, it could always be a drought. Corn could go to $6, $7. But what we want to cover is the most likely scenario. Most likely corn above 510, a 60-cent rally from here would require some fairly major news. So for now, we'll cover this, and that's why we're looking to place this here to keep the total premium down and cover just the first 60 cents. Now, this is the first choice. We have other choices that we can look at as well. Now let's look at another choice we have, and this one being the most common approach we use most years. And that is, just as we had previously discussed, buying the 450 call, selling the 510 call to give us 60 cents upside potential for re-ownership, we also want to sell a July 410 put underneath the market. Selling a put does two things. It locks us in. If July corn does fall to 410, we are locked into a futures. That's the risk side. The benefit is that selling that July 410 put will lower the overall premium of this option strategy. And we'll go over the details of the prices here soon. So what we want to do by selling the 410 puts and selling the 510 call, what we are essentially saying is that by selling those two options, we believe corn can move up 60 cents, but the odds of going much past 60 cents are fairly low. Also on the flip side, we could reown at 450 and it may go lower, but we feel it won't move underneath 410. So the two options we sell determine a range of what we expect, say 75, 85% odds to be for how corn will trade all the way out to late June. And again, as you can see on this chart, using the sold options we are using in this example covers all price levels that July corn traded through the entire year of 2025. So we are able to use a fairly wide $1 window while giving us that flexibility for that dollar window, yet still using the sold options to lower the overall premium. Now flipping over to beans, we're looking at a similar scenario. What we want to do is buy the July $11 call, which gives us re-ownership again near the fall sale price if we made any sales there, and also near the current July bean price. We're giving ourselves $1 upside with the call spread. If we stay with just those two legs, we'll be buying the $11 call, selling the $12 call, so we can have $1 worth of re-ownership. And we see again on this chart, by selling the $12 call, that does encompass all the trade prices that July beans had of all of 2025. Now on the downside, we're looking to sell the $10 put, so we're okay being locked into a futures if beans fall down to $10. And again, looking back on this chart, you see that that is below the July bean contract lows. So again, it's very much the same scenario here. We're trying to cover what we think is 70 to 80% odds of where beans will go out to late June. We're covering above contract high and below contract low with that window, the selling option window that's $2 wide between selling the $10 put and also selling the $12 call. Here's looking at some of the prices over what we just discussed for our two choices of re-ownership. First, we'll cover the corn where we're buying the 450 call, going for just over 25 cents. Selling the 510 call at 7 3/8 cents. And again, this is with current prices as of this recording. So currently July corn is $4.55, and these prices will of course change as the market moves. So this is a call-in basis. Always call in to check where these prices are. But using this as an example for what we could look at going forward, if we use our first choice where we just go with the call spread, it will save us from having any margin risk all the way out to late June. But the cost will be the 25 1/8 minus the 7 3/8. Now, if we also sell that July 410 put, we lower the cost another 5 cents, bringing at this time a total cost of 12 3/4. Now flipping over to the beans, same scenario there. If we buy the July $11 call to sell the $12 call, it's 36 3/4. Lowered. We're going to lower that cost by 11 3/4, selling the $12 call. And if we also sell the $10 put, we lower the cost another 10 1/8. So with July beans at 10.85 3/4, this is currently priced at 14 7/8. Again, this is just a scenario given current prices. These will move, and also we can also change strike prices to whatever we see fit. We saw on the previous charts why we are choosing these strike prices. We're letting those sold options give us a window above contract highs and below contract lows. If we feel that we want a larger window or a smaller window, that's what we want to call in to discuss one-on-one, because as we change those windows, we can fine-tune these to any level we like, and then we'll be able to talk about what that does to price. The larger window you give yourself on the upside and downside, the higher the cost. The smaller the window, the lower the cost. So the sold options come down to what we feel on an individual basis are the most likely scenarios for corn and beans going out to late June. So those are the options that we're looking here for 2026 July reownerships. As we turn the corner from fall through winter and into spring planting, these July reownerships will cover us through first the January crop report in a couple of weeks, then of course any changes to the China trade agreement that will obviously affect beans the most, but that of course will spill over some influence to corn. And then of course spring planting weather, early summer planting weather. These options do go until late June, so we are covering all those scenarios. So call in, let's go over the details of this. Selling those puts, it changes how much margin risk you have based on which put you choose. For example, selling an at-the-money put margins half as much of a futures. Some of the puts we've used in these scenarios get down to 20 or 30% of the margin risk that a futures would take on. And we can fine tune these. That's part of what we enjoy about these the most. We can take the options as listed here, change the strikes, see what that does for price, and fine tune the strikes to what each individual feels we will be seeing in 2026. So of course, like I mentioned, call in, let's go over these options, and if we just want to talk farming, I'm always a fan of talking farming and going over any other market that you want to cover. I wish everyone a great end to 2025 and a good start to 2026, and we'll talk again soon.